Zero foreclosures caused by bad loans. That's the strange twist sitting at the center of this story. In 2008, the entire system cracked because banks handed mortgages to people who could never pay them back. Today, credit standards are some of the tightest in decades. Buyers are qualified, income verified, fully underwritten. And yet, in 10 specific US cities right now, foreclosure filings are climbing at a pace that mirrors 2008 almost exactly. Same warning signs. Same rising inventory. Same panic setting into local markets, just without the one thing that supposedly caused it all last time. So today, we are mapping out the 10 cities where this new kind of foreclosure wave is building and unpacking exactly why it's happening without a single subprime loan in sight. On number 10, Cape Coral, Florida, where the math simply stopped working. This city rode one of the steepest price surges in the entire country, homes appreciating well over 60% between 2020 and 2022. Here's the breaking point. None of those buyers took out a risky loan to get in. They qualified fully, put money down, and locked in reasonable rates. But then insurance premiums doubled, HOA fees climbed, and property taxes reset to reflect inflated values, stacking thousands of dollars in new annual costs onto perfectly normal mortgages. Picture a household that passed every underwriting test in 2021, now watching their total monthly cost balloon by $1,000 a year later, with a paycheck that never moved. Would you keep affording a house that got more expensive after you already bought it? A growing number of Cape Coral owners simply can't, and foreclosure filings here are proving it. On number 9, Punta Gorda, Florida, the storm bill that never stopped growing. This is a market with an older, mostly retired population, and here's the breaking point. Hurricane Ian forced insurance premiums into a permanent new tier, some homeowners watching their annual bill triple in just a few years, completely unrelated to their loan terms or their ability to pay principal and interest. That's the part that makes this different from 2008. The mortgage itself was never the problem. The carrying costs wrapped around it were. Picture a retired couple on a fixed income, current on every mortgage payment for a decade, suddenly unable to cover an insurance renewal that costs more than their original monthly payment did. That's not a credit failure, that's a cost of ownership failure. Would you call that a housing crisis or an insurance crisis wearing a housing crisis's clothes? Either way, the foreclosure notices in Punta Gorda don't care what you call it. On number 8, Lakeland, Florida, overbuilt and underpriced from day one. Lakeland sits quietly between Tampa and Orlando, and here's the breaking point. Economists tracking the area found homes here were overvalued by more than 30% compared to where fundamentals actually justified pricing, meaning buyers who purchased at the peak were underwater before insurance or taxes even entered the picture. These weren't shaky loans. These were fully qualified buyers who simply paid too much for an asset that was never worth what they paid. Picture handing over down payment on a home that's already worth less than your mortgage balance the moment you sign the papers, through no fault of your credit at all. Would you keep grinding to pay off a loan on a house that's underwater from day one? A lot of Lakeland owners are deciding the answer is no and simply walking away. On number 7, Jacksonville, Florida, when the institutional buyers vanished. Jacksonville spent years as a favorite target for Wall Street landlords buying up entire neighborhoods. Here's the breaking point. Those same institutional buyers have pulled back sharply, and without their constant purchasing pressure propping up prices, values have started sliding just as regular owners' property taxes and insurance costs climbed 63% since 2020. None of that has anything to do with how the loan was underwritten. It's simply the cost of holding the asset outpacing what regular wages can support. Picture a homeowner who did everything right, verified income, solid credit, reasonable loan, now falling behind purely because the bills around the mortgage grew faster than the paycheck ever could. Would you have predicted a healthy loan could still end in foreclosure? Jacksonville is proving that it absolutely can. On number 6, Ocala, Florida, the FHA safety net that vanished overnight. Ocala pulled in a wave of buyers using FHA loans, the low down payment option built for exactly this kind of buyer. Here's the breaking point, and it's structural, not personal. Pandemic-era forbearance protections that once cushioned struggling FHA borrowers have expired, and nationally, FHA foreclosures have jumped 28% since that safety net disappeared. These loans were underwritten properly. The borrowers weren't reckless. The protection layer around them just got pulled away at the exact moment costs kept climbing. Picture finally securing your first home through a program built to help you, only to watch the support system quietly dissolve the moment you actually need it. Would you have known that safety net had an expiration date? Most Ocala buyers didn't either, until it was gone. If you want to understand which markets are repeating 2008's warning signs without repeating its causes, hit subscribe. We track this data every week so you see it before the headlines catch up. On number 5, San Antonio, Texas, the overbuilt Sun Belt hangover. San Antonio spent years building aggressively to keep up with population growth that has since slowed considerably. Here's the breaking point. Builders kept construction running at boomera pace even as buyer demand cooled, leaving new subdivisions competing directly against existing homeowners trying to sell and pushing prices down across both categories at once. Buyers here didn't take on bad loans. They bought into a market that builders simply refused to stop overbuilding, even after the writing was on the wall. Picture owning a 5-year-old home now competing against a brand new one down the street with a builder incentive attached, and watching your equity shrink through no decision of your own. Would you have guessed overbuilding alone could trigger real distress? San Antonio is the proof that it can. On number 4, Austin, Texas, when remote work reversed the boom. Austin became the poster child of pandemic relocation, tech salaries flooding in, prices soaring in response. Here's the breaking point. As companies pulled workers back to coastal hubs, that migration wave reversed hard, and home values have fallen from their peak by some of the steepest margins of any major metro in the country. The loans behind these purchases were properly underwritten at properly qualified rates. The problem is the asset itself lost value faster than owners could build equity to offset it. Picture buying at the absolute top of a boom, doing everything financially responsible, and still ending up underwater purely because the migration wave that built the market simply reversed direction. Would you have seen that coming in 2021? Almost nobody in Austin did. On number 3, Boise, Idaho, the quiet correction nobody's watching. Boise doesn't get the national headlines that Florida or Texas markets do, but here's the breaking point. This market saw some of the fastest price appreciation in the entire country during the boom, and it's now seeing one of the sharpest corrections, with a wave of out-of-state buyers who purchased at the peak now sitting on properties worth meaningfully less than they paid. These were healthy, fully documented loans from qualified buyers. The only variable that changed was the market itself resetting to something closer to reality. Picture relocating your whole life to a quieter city, doing every part of the process by the book, and still watching your investment shrink simply because you arrived during the peak of a bubble nobody labeled as one yet. Would you have known the difference between a hot market and a bubble in real time? Almost no one in Boise did either. On number 2, Phoenix, Arizona, the investor exit that's still unfolding. Phoenix absorbed one of the largest waves of institutional and individual investor buying of the entire pandemic era. Here's the breaking point. As rents have softened and holding costs climbed, those same investors are exiting in large numbers, and because so much of the market's recent activity was investor-driven rather than owner-occupied, that exit is adding inventory back onto the market faster than organic demand can absorb it. Regular owner-occupants here took out completely standard loans. They're simply caught in the downdraft created by investors leaving all at once. Picture buying a normal home for your family only to watch your neighborhood's prices slide because half the block was actually owned by rental investors quietly heading for the exits. Would you have known your neighbors weren't neighbors at all? A lot of Phoenix families are only realizing that now. On number 1, Cape Coral, Fort Myers, Florida, ground zero for a foreclosure wave with no credit crisis behind it. If there's one metro where every single non-credit driver of distress stacked on top of each other at once, it's here. Here's the breaking point that puts it at the top of this list. Home prices surged more than 60% between 2020 and 2022 on completely conventional financing, and now this metro has posted the single largest home price decline of any major city in the entire country, while insurance premiums here can run anywhere from $3,000 to over $7,000 a year, layered on top of mortgages that were fully qualified from day one. None of that is a credit story. It's a carrying cost story, a migration story, and an overbuilding story, all colliding in the same zip codes at the same time. Picture a homeowner who did everything a lender asked of them: verified income, solid down payment, reasonable debt-to-income ratio, and still ending up in foreclosure because the cost of simply keeping the house grew faster than any underwriting model accounted for. That's exactly why Cape Coral Fort Myers takes the #1 spot. So here's the big picture after all 10 of these cities. This isn't 2008 wearing a different mask. It's something genuinely new, a foreclosure wave built not on bad loans, but on the rising cost of simply holding onto a home that was properly financed in the first place. Insurance premiums that tripled, property taxes that reset to inflated values, migration waves that reversed without warning, and investors exiting all at once. None of that shows up in a credit score, and none of it gets fixed by a rate cut. That's the uncomfortable truth sitting underneath every one of these 10 cities. The lending system did its job. The economy around the loans simply didn't hold up its end of the deal. So if you're a current homeowner in any of these markets, the one thing worth doing right now is running your true carrying costs, insurance, taxes, and any HOA or assessment risk against your actual income, not your loan payment alone. Because the house you can afford to finance isn't always the house you can afford to keep. All right, that's the map. 10 cities, one uncomfortable new version of a foreclosure crisis nobody printed a warning label for. If this changed how you're thinking about your own market, hit that like button, drop a comment telling me which city surprised you the most, and subscribe so you don't miss what we uncover next. Thanks for sticking around till the end. See you in the next one.